Hi, welcome to the Daily Exchange. I'm James O'Donoghue, and today we're joined by Alex Saunders from Nuggets News. And we're going to be diving into the US repo market and the dramatic breakout that we saw in mid to late September, about 2.5 weeks ago, and look at some of the implications of this. And the other areas we're going to be talking about the more recent changes in Australia where the RBA has cut interest rates for borrowers. Now, Alex is from Nuggets News, and it might be great if you could give us a little intro about who you are and where people can find you online. Might be a good starting point, Alex.
Yeah, thanks for having me on today, James. So I guess my financial interest started around the GFC, which was the last time we saw the repo markets really in the news. So I was a pharmacist by trade, and I fell down the investing rabbit hole after the GFC and wanted to learn about banks, debt and money, and the financial system has really been my interest ever since, particularly ever since Bitcoin came around. In my world, that was back in 2012. So it's very interesting to see people talking about these subjects that were pretty even taboo, interest rates, negative yielding bonds. No one was really interested in this stuff, and it was off limits, and now it's, I guess, in the public realm.
Yeah, it's a super interesting space, and I guess it's one of those things that pops up, like no one needs to know about repo markets, and then all of a sudden they're important. They're affecting things, they're affecting macro things as well. And so now we come to videos like this where we can explore them a little bit. And then maybe, hopefully, if things pan out okay, we can put them back aside for a little while. I thought it would be good to start with pointing out or making you guys aware that Finder and HiveX are partners with the Gold and Alternative Investments Conference that's going to be held in Sydney later this month in October. It's predominantly Australia's largest gold and bullion conference. It's run for about a decade, and now this year they've included a third day on Saturday the 26th of October that's entirely dedicated to cryptocurrencies, blockchains, understanding sort of the ins and outs of different digital assets, why some are risky and scammy and why others sort of have a little bit more merit. And our involvement in partnership with the conference has been to structure out an entire agenda around a day to have different speakers come and help, inform and educate the conference attendees about all sorts of different aspects. So from the tech side to markets. And then we also have Alex as a good example coming in to talk about the sort of broader macroeconomic look, what we're seeing governments do in response to the way that their own currencies are behaving and the different pressures there. And so I guess see this little segment now as like a taste of what Alex will be presenting about in a much more broader and larger amount of time. And yeah, if you're interested, links in the description, and you can come along to the conference. It's October 26th. It's goldevent.com.au, even though there's an extra whole day of crypto in there if you're interested. So Alex, over the overnight repo lending rates in the US in the second week of September saw a massive breakout, and the outcome of this was that it extended higher than the Federal Reserve's sort of band that they like to keep it in, and it went up as high as 9%. And my understanding is it was meant to sit somewhere between 2 and 2.25. And so as a result, we've seen the Fed come and inject capital into this space to lower that rate. But what does that mean? What are we looking at when the Fed sets these rates? What's the repo market even?
So central banks set that target interest rate for the risk of money, how much it should cost to borrow money. Like all things, it's based on supply and demand. And it works well when the system is flowing around okay. In the repo markets overnight, sometimes banks need more reserves. They need more cash on hand to back up all their positions that they have, loans on their book. Even though they still have that fractional reserve system, you still have to have a set amount of reserves to meet the requirements. Now, what happens at the end of that day if they don't quite have enough? Well, they have to sell some assets, and the most liquid assets, the easiest to sell, are high quality stocks, and particularly bonds, US treasuries. So why on earth banks are paying 10% to try and get some money just to shore up their reserves, and why are people even paying that much to borrow a treasury that has a 2% yield? None of this stuff really adds up, and the reason that it's worrying is because banks aren't lending to each other when they should be. So why aren't other banks lending? They're afraid that other banks might not be around the next day or the 14-day repo market 2 weeks later. They're worried that if they give them cash in exchange for the treasury bonds, all their other liabilities on their books aren't going to match up to their assets, and that's when they become insolvent. We're seeing the ECB banks constantly, being spoken about, being on the verge of the collapse, and we saw it in the GFC. So people are worried, and banks are worried about other banks not being safe.
Right, okay. And so it's kind of like on a normal day in the repo market, I'm a big investment bank. I need some cash to continue my business, so I go and I sell some of my assets in an agreement, a repurchase agreement, so that the next day I'll buy those assets back, but it enables me to have some capital overnight. Is that more or less how it works?
Yeah, you get more dollars on hand. It's like in our margin trading account, you have to have that collateral to back all the position that you have. And normally these banks are happy to swap with each other because it's a US Treasury bond. It's meant to be, almost a risk-free asset, a safest asset. But now these banks are too afraid to lend money and buy treasuries off each other. And the other thing that tells us is this world of derivatives and rehypothecation is very murky. So if we have three banks and one owns a US Treasury bond, and then the second bank knows there's a third bank that actually wants to borrow that to have on their books, and they sort of facilitate that swap. Well, the first bank says, yeah, we've got a Treasury bond, we've just lent it out. The second bank says, yeah, we're minus one on our books, we've borrowed that to give to someone else, but we're going to get it back. And then the third bank says, yeah, we've got that US Treasury bond now because we've borrowed it. There's two banks that last one. But what's happening now in the world of GAAP accounting and derivatives is that both those banks that have the treasury have that on their book as an asset. And what we're seeing in the repo markets is that even 3 or 4 banks are all claiming that they own that asset. And people have heard about this before in the gold market. It's kind of become a bit of a conspiracy about how many claims there are for each gold bar on the actual underlying for each bank that has one on their books. So yeah, it's all just rehypothecation, smoke and mirrors, and the banks are afraid of. It's like musical chairs. The banks are afraid, well, when the music stops, who's actually got this asset, and they're not prepared to take that risk with one another.
Yeah, right. I guess it's it's a funny concoction. And I guess is the idea that when there's less trust, people start requiring a higher interest rate to make them accept that sort of agreement, right? They want 5%, not 2%, if they're going to take on this risk. And then 6, 7, 8, 9, and then the Fed comes in and starts injecting their own money. So you're repoing with the Fed. Is it fair to say? What happens when the Fed steps in?
Borrowing off the Fed, they're the ultimate backstop because no one's worried the Fed are going to collapse. They get to print money out of thin air. And
right.
So this is where the Fed comes in and says, "Whoa, rates have spiked up to 10%. These guys are too scared to lend to each other. Let's inject a heap of money. We're talking hundreds of billions of dollars into these markets to give them the liquidity they need. Then they can swap it back off us the next day, or we have 14-day repo markets as well." And the Fed is saying that we're going to have to basically do this every day for weeks or possible for the foreseeable future. And this is a little bit different to QE that they did a while back, which we can get into as well if you like.
Okay, cool. Yeah, I think it's really interesting. And the analogy of the musical chairs, like if you're aware that there's only 6 chairs and there's 7 of you, everyone knows that there's the problem. But as long as it's like the music's still playing, right? People start looking for their chair because they think it's about to stop. The music kind of slows down. And then the Fed comes in and goes like, next song, and it just keeps playing, right? So I think, it's a complex thing. And do you think when the Fed has to get involved, because like the game's fine, everyone's having fun, playing around, everything's sweet, and then we all look over and we see the Fed pressing, turn the volume up. Is that a sign of like some sort of systemic risk? Is there a chance that eventually there won't be another track to play? Or is this something do you think can go on indefinitely?
Yeah, so this is basically similar to what we saw in 2008, where it's all dandy when people are wrapping up these mortgages and CDOs packaging them up and selling them to other banks, and everyone's happy and buying them, and there's only one person on the side of the market, and that's the buyer pushing up prices. And that's similar to what we've seen in the bond market. Everyone is buying bonds. Similar to what we've seen the Fed do. They're only buying bonds. So it's all merry when everyone is buying and happy. But once we need to sell these, or we need someone on the other side of the market, that's where there's just not the liquidity, and there's there's not enough money in the system. So that's where it gets a little bit worrying. And at the moment, the Fed is shoring up those overnight markets by being that buyer of last resort. But it's probably a good segue to talk about how this differs from QE.
Yeah, actually, that'd be a great topic to dive into. I think the QE side, it's almost, I read some sort of discussion around, is this like a secret way, like a sneaky way to effectively have the same outcome? It'd be good if you could explain why it is or isn't, and then maybe what QE actually is.
So QE was the process of Fed creating money and buying assets off these different banks, so buying bonds. And when we had the GFC and we had a lot of those bad CDOs, collateralized debt obligations and bad mortgages, we had the Fed sort of buying different assets off banks. Now in Japan, we've seen the Fed, or the Bank of Japan there, go as far as to start to buy ETFs and stocks and other things because they're so desperate to keep asset prices propped up. They don't want everything deflating and going into a recession or a depression. So in that instance, the Fed are constantly creating money and constantly buying assets off these banks, and that puts money into the banks, so they've got more liquidity, which is what they don't have at the moment because the Fed have stopped doing that. The Fed have stopped QE. But what the Fed are now doing are saying, well, this is just overnight operations, all these 14-day repo markets. It's not an ongoing thing. We're going to buy them back off you, or you have the agreement to repurchase them off us. We're just injecting capital for overnight or as long as you need it. But it's one step away from just increasing their balance sheet and starting to print more money. It's just showing us that the system doesn't work. All this rehypothecation, fractional reserves, it's all just this big game where everyone makes money when everyone's a buyer. And as soon as something looks like it wants to go the other way, the Fed are going to have to step in and print money.
Yeah, right. And just to clarify, is rehypothecation what happens when an asset is bought twice, sold to two different parties?
Yeah, or even go further. These days we have options, futures markets that are all based off an underlying asset like gold, but you don't trade any real gold. So all of a sudden those markets grow enormous. We see the gold and silver market, the daily traded volume is bigger than the actual amount of gold and silver that gets produced in a year in the real world. So that's where we started to get into the world of derivatives and fractional reserves, as well as rehypothecation, where there's 10 banks that all think that they own that one real gold bar if those futures contracts ever were to actually settle to the real thing.
Okay, yeah. So for the repo market, I mean, a lot of the trading that's going on is between very large institutions, the Federal Reserve, big banks. How is this relevant to people like me, right? Just everyday retail investors or people that don't even invest at all, right?
I think it's relevant because of the way the banking system works, and the GlassSteagall Act, which was trying to break up the banks from banks where everyday lenders come in and they get their mortgage or they get their business loan, trying to separate that stuff out that's legitimate with all the speculation and gambling that happens on Wall Street these days. Futures trading, rehypothecation, let's separate that out. But at the moment, it's all in under the one roof, under the banks. So when this sort of thing starts to happen and banks are risking collapse, like we saw during the GFC and these US banks now following down the path of the European banks, which looks to be very fragile, that's going to hurt depositors and the everyday person if this all goes under, where we have the bail-in laws now. If they don't have enough liquidity, all your deposits are going to get bailed in to form that liquidity.
Right. Okay, that doesn't sound ideal. Hard-earned savings being used to fix problems that perhaps weren't the best addressed. I guess that's probably a nice time to talk about alternative investments like gold and Bitcoin. Is this something that amplifies their use case or the reason that you would want them? Or is it just a greater reason to hedge against this kind of risk? Is that what you're doing? Or do they still remain susceptible to negative impact if this thing does go the only way it seems like it can, right, on a long enough timeline?
Yeah, and I think if we have a big collapse, another GFC style event, then all those gold futures contracts and ETFs and all those derivatives that we talk about, they're probably going to sell off really hard. So the price of gold we see on the screen is probably going to go down. Maybe even Bitcoin now that has futures trading, we just don't know how that's going to react. But at the end of the day, when all the dust settles, the wealthy are going to want to park their money in real things. So whether that's property or whether that's gold or something that's outside the system that doesn't carry this risk, and that's where Bitcoin and gold have definitely been shining bright of late. So we see a lot of wealthy people starting to take risk off the table. Markets have performed extremely well for a number of years now. If you've accumulated a lot of wealth, why would you still be risking it if you see all this stuff on the horizon when you can park a lot of your money in, particularly physical gold outside the system?
Yep.
And this is where other people are viewing Bitcoin as something that's just completely outside this system.
Yeah, I agree. Okay, I think that it makes a lot of sense, right? You don't want your savings or your money, your assets, whatever it is, in a form that can be captured and controlled, taken off you, reduced in some sort of way. Obviously, if there is a collapse and it affects the futures prices, that would pull cryptocurrency and gold down, but at least you might still hold it in the case of gold or Bitcoin. So maybe at least it can't be taken off you, I guess, might be the takeaway there. I think it's probably a good time to look more locally at Australia and then also look at how Australia is just an example of what we're seeing elsewhere. With just yesterday, the RBA has reduced the cash rates down to 0.75%. I know that Finder here has done research with 39 different economists, and there's a 77% rate of those who think that we'll see another further drop to 0.5%. It'd be good to talk a little bit, work out what that really means for everyday people. I think that that's something that exists much more in our closer sort of world. And maybe things like, what does that do for home loans versus savings accounts? Are you incentivized to save on a lower interest rate from the banks?
Yeah, so we've got this entire baby boomer generation that wants to retire now, and again, they've accumulated a lot of wealth and assets, but now they're getting less and less on their savings, so they're really hurting. And again, in central banks, they kind of live in this fairyland where they think that lowering interest rates, that people have no incentive to save money, so they're going to go out and spend it and get the economy going. That's not really happening at all. What people are seeing is that they're getting less and less on their savings, so they're actually spending less. It's working in the opposite effect to what central banks have intended. Now, it does work well if you're a homeowner or you've got heaps of properties and heaps of debt. It brings down the interest rates on your debt. But at time of recording, there's a couple of banks that haven't announced they're going to pass any of that rate cut on that the central banks have delivered. So we're still yet to be seeing if the general population is really going to benefit from this.
Right, okay. I would have thought that the only way this might have a chance at working is if they do pass the lower rates on, right? To incentivize borrowing. Otherwise, why would borrowing change? Is that a fair kind of thought?
It depresses banks' margin. So banks are very hesitant to pass this on because if they're making mortgages cheaper for everyone, it helps the person with the mortgage, but that chops another, it's 25% of their profits these days if the rate's gone from 1% to 75 basis points. So this is why banks are really reluctant to, and they often only pass on, half of the amount.
Yeah, right. Interesting times. I think that I think it'd be good just to pause for a second, kind of zoom out. Where do these things cascade to? Like, is quantitative easing the next logical step? Is there things, I know I'm not an economist, so I don't know how to talk to this one, but I hear talk about negative gearing and things like that, where potentially around the world you're seeing negative rates on savings accounts. Is this like a linear kind of playthrough that we should expect? What comes in and prevents this? Is it fair to say that this is like a kicking of the can for an inevitable thing, or is there a good chance that the stimulus works and things just fly back up and we're fine?
Yeah, so if anyone watched the documentary we did, Australia, A Coming Financial Crisis, it's our belief that unless we have some big structural changes in the way that our economy works, it's just way too focused. The government, the central banks, everyone is focused on increasing house prices and reinflating this bubble, even though before the election people were talking about how housing is unaffordable. So that seems to be our only goal, dropping interest rates and increasing asset prices. And I think that's going to lead to possibly a bigger bubble. Even stock market in Australia reacted really strongly to this news, as well as housing markets that are rebounding strongly. But ultimately, because there is so much debt, people have no way to pay it down because they're not getting wage increases at work. So unless we keep taking interest rates lower, the system just cannot work. So it's almost a mathematical certainty that we go to negative interest rates.
Right.
People think that's crazy, but look, they're spreading across Europe. Half of the world bonds these days have negative rates. This is the new normal that we live in, and it's pretty crazy to think this has become the new normal.
Is the other option for, I guess, the people that make these choices to come to terms with that and force Australia into an early recession? Is that on the cards, do you think?
So a recession would certainly do a lot to, cleanse out the bad investments and bad businesses. But at the end of the day, we still need structural changes so that entrepreneurs can start new businesses and create new jobs, high-paying jobs, and bring innovation back to Australia. So there's no point in having a recession if there's going to be nothing to save it. So at the moment, we're way too reliant on government. And even if we go down this path of the people's QE, they call it, or universal basic income, if governments have to start handing out money to people directly, like we saw in Australia with GFC, that's when we get the risk of actually having inflation, where we're forced to raise interest rates to stop inflation getting out of control at a time when everyone has a lot of debt. That would probably make things even worse, the crash that we have down the line. So it all comes back to actually making structural changes in our economy that create good wage growth, high quality jobs and innovation in Australia, and get away from this mindset where everyone has to have heaps of properties, get on the property ladder, invest in property. Seems to be the only focus in Australia.
Absolutely, it really is, and I think it's been almost like a historical kind of focus, right? You just grow up knowing that that's what you should be interested in, get a home, and it's always been property in Australia. That's certainly been my experience. I think it's really interesting you talk about a documentary that you have. Can you let people know where they can find that?
So if you just go to YouTube and type in Australia, a coming financial crisis, it's there free to watch on our Nuggets News YouTube channel.
Very cool. I love it. Is this one of the main, when you look around the world and see these different things happening, how heavily does this lean into your investment thesis into things like Bitcoin or gold? Is that a major component, or I guess you focus more on the tech side?
Looking at those assets and what was happening around us back at that stage, everyone was talking about this QE being the punch bowl that markets will never be able to survive without. And then the Fed promised that they were going to take away that punch bowl last year, and markets started crashing and there was panic everywhere, and the Fed have come back and pushed that punch bowl. They're handing out glasses of punch at the moment is the way to think about the repo market. But they're talking about giving that punch bowl back forever. So markets are addicted to this low interest rate and free money environment. And if we didn't have that, then valuations would be a lot lower on a number of asset classes. So yes, this is exactly why I went down that rabbit hole all those years ago. And if anything, it's become more bullish, the case for gold, Bitcoin, because nobody would have thought that negative interest rates or deeply negative interest rates, where you actually get punished for having money in a bank, would be a real thing, let alone the money printing and everything else that banks are doing. And the whole financial system is just showing that it fails unless we perpetuate this bigger debt bubble.
Yeah, 100%. I think it checks out with me personally, and I think also property is so far away for a lot of people, and if you're saying to them, this is coming, if you hold savings, it's not going to be so great for you, so buy a property. It's a little bit, it's not really a helpful answer, right? But there are other asset classes, I guess, that are more attainable for any sort of size investment, which I think is nice. Obviously, people need to do, that's not advice, that's what I'm saying now. Very cool. Look, it's been fantastic having you on the show. I think it's been really insightful, and I hope that people are teased a little bit about what they can come and learn from you in a much longer session at the Gold and Alternative Investments Conference. Come join us on October 26th. Otherwise, check out Nuggets News, their YouTube channel. There's a website. There's loads of different ways that you can connect with Alex. And let us know in the comments how you feel. What are you worried about? Any final words from you, Alex?
No, I'm looking forward to that conference. There's a lot of overlap with what the gold and the Bitcoin community believe, so it's going to be great to see everyone there.
Absolutely. Very cool. Thanks.